Committee meeting.
Good for
Go ahead.
Rick and Randy.
Good morning.
All right. Thank you, Mr. Chairman. Good to see everyone. And the first item, as you can see here on the agenda, is the MDC plan document. This is an item brought forward from last time where we request final adoption of the changes to the plan document. You should have that in your materials, and we'd be happy to answer your questions, but this is basically, or is, to add the Roth provisions or after-tax provisions that we'd requested in legislation. The proposed changes are the same as the proposed changes last time during initial adoption, and the legislature did pass this provision in the last legislative session. So unless there are questions, we would ask for the committee's final adoption.
Sounds like we're going to hopefully do this every year for 3 more years. I think.
Yes.
3 more years. So is there a motion to approve this change?
So move.
There
A second.
All those in favor say aye.
Aye.
Any opposed? The motion carries.
It's effective July 1. Roth is effective July 1.
That's right, July 1st. Yes, sir. Yep. All right. The next item is similar to that one, and is for the ORP plan document that you should have in your materials. This, too, is a request for final adoption based on the last time, and the proposed changes here are the same as the proposed changes in the initial adoption earlier. And these changes in the ORP plan document simply update the contribution rates to reflect the current rates in statute. And unless there are questions, we'd like to ask for your final adoption.
Is there a motion to approve?
Motion.
Is there a second?
Second.
All those in favor say aye.
Aye.
Any opposed? And the motion carries.
All right, thank you. The next item is Tier 5, and this was just intended to give a brief update on Tier 5 implementation. Pleased to report that Tier 5 is live, and all in all, things are going pretty well. Certainly still a work in progress and working through some things, but nothing that's too concerning or too much of a surprise. And just to remind you of the dates, of course, it went live with employees hired March 1st or later. But the reporting comes in the subsequent month, which would be during April, which of course is the month that we're in now. But all going pretty well. Would certainly like to thank you for your support and your work and involvement, and especially that of the staff and employees and the team members involved in doing a lot of the heavy lifting. And collectively, just to recap at a high level, we've really accomplished a lot in the last year or so, or I guess you could say even less than a year. A lot of which involved the board's involvement in board work as well, to include selection of the third-party administrator, development and adoption of the plan document, the investment lineup, modification of regulations, certainly the programming and any IT changes, communication, employer training, outreach, things of that nature, which has got us this far. And as of recently, we have between 500 and 600 new Tier 5 members from over 200 employers, and continuing to work through and reconcile that and move forward. As I start to close, I would really like to thank the staff and the team again that were involved in doing the heavy lifting to get us to this point. There's certainly many to list out, whether that be on the IT side and the programming side or the employer reporting or other member and employer services staff. Too many to list, but I do want to recognize 3 individuals. One being Lauren Cameron, who works in IT, that we designated her to be our project lead and done a nice job as the internal project manager. And then also Ms. Devetta Lee and Mr. Mason Frantham, and of course some of the staff members and team members under Mason. I really appreciate them and others. Again, there were many more involved. On that note, to some extent and varying degrees based on their responsibilities, all of the executive team was involved in some manner. For example, Charles with the investment lineup, or Shelley with communications or the handbook. But I especially want to recognize those 3. Too many to list out. I wouldn't want to leave anybody out, but I really appreciate their work. I know on some of the training, some of you that are represent employer agencies had complimented the training, and we appreciate your feedback. And with that, we would all be happy to answer any questions should you have them.
I have one, and this will be to other members of the board. Of course, I think my understanding, Tier 5 is now basically law. First responders and firefighters and whatever were very unhappy with it. What was their concern, and was that addressed in the revision of the bill? Does anybody know?
My
So,
sense is yes, and I think we need to be given a complete list of the changes that we had looked at, and so that, and my question is, I'd like to see how closely those changes moves it back towards the tier 4 in some instances.
sure. Well, go ahead.
Yeah, they're really angry. They're not gonna be able to, they're gonna have a hard time hiring people. The sheriff of Long Beach, it's been on the radio talking about it. I've talked to the sheriff of Lucedale. I've talked to several public, first responders. You know, it's not just a 25-year thing. It's the fact that there is no COLA anymore. And they are going to have a tremendous time hiring any specialized individual. I've talked to people in the Attorney General's office. I've talked to people at MDOT. I've talked to people on my own staff. Anybody specialized, they have no COLA anymore. I mean, and it's not worth it to them. They'd rather go in the private sector where they can get a bit, cost a bonus, or their pay is not as much. It is a legitimate concern, and the sheriff of Long Beach, sheriff of Lucedale have expressed disappointment in the whole thing.
Mr. Trey, I've heard that same argument from several sources, but is there any data to support that, or is that just their anticipation that it would be difficult to hire folks?
They were having a hard time hiring people anyway, and on the same fact that, you know, take out the pay part of it. They were having a hard time hiring people anyway, and the fact that now there's not enough data to prove them right or wrong, and maybe they're wrong, and maybe they're very wrong, but I don't know. But when you're not having, when everything costs more today than it did yesterday, and you're not giving them any cost of living adjustment because of it, then that is a legit problem for people not being paid a lot of money.
Well, I was the one that made the motion that it be sent over to the legislature for their consideration. And my only beef about it is we were asked to do something, and I don't remember folks coming out of the woodwork to make suggestions of what we do. So we did something, and now nobody likes what we did. But what was their alternative?
Again, Mr. Commissioner, my sixth thing, go back and talk to their mayor, their supervisors, their associations. Those were the people who said, we cannot pay what the employer cost needs to be to sustain that program. They were, that's what drove the whole thing. And it's back to a local issue. If you can't pay for that, what are you going to pay for? And you're going to have to pay more to hire people is what it comes down to. But we followed, you had the leader of MML beating the doors down, saying we can't pay that cost. If you can't pay, there is a cost associated with anything that happens. They wouldn't pay for it, and this is what they get. And you know, and it may be, I don't know, it may turn out to be, there are some employees who want something portable. There are some employees, and so I think it's just going to take time to tell. This may work out for employees, may not. I don't know, but there are employees who like the portability of a defined contribution, and because they don't plan to stay 30 years at any place. But again, the reason for the whole change is local folks saying we can't pay for it, and that's where they need to go talk to. That's not our problem was making sure that we sustain the system for the existing members and the existing retirees. And I think we did that.
Yeah, I mean, we're kind of in an interesting situation. I mean, like, Chris was here, he and I are in a different situation. We kind of have two hats. Y'all have a hat. We all have different hats to wear in this. You know, we have to balance the idea that we need this program to work. We need to make sure it's safe, it's affordable. And I think people do want the portability. I think that's a fascinating part of something that we're doing. I don't think the first responders or people thought the COLA would be gotten rid of. And you talk to some legislators, I don't think they knew they got rid of it. And, you know, even though there is an ad hoc, and Daniel, if he was over there, would be arguing with me right now that they did set something up, it's ad hoc. I think people, you know, Hob Bryan was right. You're going to politicize something that should not be politicized. You know, I don't agree with him very often, but he was actually.
Now, what does he mean by that?
Well, if you have an ad hoc, well, why give it on normal years? Why not just give it on a political year? Why? And if you give it once, well, why not give it twice? And I'll give you a perfect example. And I'm sure we didn't mean to go down this road, but I have an example that I was reading about. The Cincinnati School Board has trouble with their pension because they have an ad hoc version of it. So one year, the teachers convinced them, for right or wrong, I don't know, to give them a COLA. Well, they gave it to them one year, then they had to give it to them another year. Then they had to keep on giving it. So then you had a problem. Why didn't you just go ahead and set up a COLA that would have been sustainable? But you did it the ad hoc version, and now their system in Cincinnati is struggling on the struggle bus. So, I mean, Hobb was right. I mean, it will be politicized, and it is a problem, but it's a problem in the future, not today.
It's a long time that, we're just getting folks into the system.
Right.
It's gonna be 30
We may be
years from
complaining
now.
about something that's not necessary, but I think the hiring part is the part that is problematic today. But we'll see how that works out. Anyway, we went down a road we probably didn't mean to go down today.
Let's try to get back on track. Any other comments from you, Ray?
No, sir, on that, just really, I was speaking more, of course, to the implementation of Tier 5 as passed into law.
George asked.
That's right, and we,
Like George.
and
Can we continue this discussion under the legislation update?
I hope not.
Seems
Yeah.
better. Anything else on that topic?
Other than also just wanted to thank our partners with Empower. That was really all that I had on that.
Okay, miscellaneous updates.
Just one quick one. We were advised of a merger or potential merger with Corebridge, one of the ORP vendors, and Equitable Holdings. So as we learn more about that, we'll share that with you, but that's really all we had.
Okay. Any other business for the Defined Contribution Committee? Okay, we'll turn it over to the Investment Committee then.
Thank you.
I'll call the investment committee to order. And I believe, let's see if I can go back to the headlines here. I'm going to turn it over to you, Charles.
Thank you, Mr. Chair. Quarter ending March marked significant volatility across global markets. Geopolitical developments, renewed trade tensions, and shifting central bank expectations contributed to a broad reassessment of risk. The conflict in the Middle East and the resulting disruption of energy flows throughout the Strait of Hormuz drove a sharp rise in commodity prices and refocused markets on upside inflation risks. This dynamic led to simultaneous declines across equities and fixed income, as well as the unwinding of several previously crowded positions in equity markets. Equity performance varied across regions. The Japanese equities benefited from currency weakness and political stability, while European markets were weighed down by elevated energy costs. In the United States, technology shares came under increased scrutiny as investors reassessed AI-related capital expenditures and durability of existing business models. Fixed income markets experienced similar pressures, with central banks adopting a more cautious stance in response to energy-driven inflation shock. Now, however, in April, market sentiment improved. Progress in the Iran-U.S. discussions aimed at de-escalating the Middle East conflict has supported a broad rebound in risk assets, and the S&P has reached new record highs, led by a strong recovery in the tech sector. So for the period, PERS delivered a fiscal year date return of 7.56% through the end of March. And performance has strengthened even further, reaching an estimated of 13.88% by close yesterday. Incredible rebound. So our reps from Callan are here, and they're going to take you through a little deeper into what happened last quarter.
Thank you, Charles. Good morning, everyone. So certainly a lot of excitement in the markets as we saw really a shift from broad-based recovery, risk on in January, mixed results in February, declining results in March. And then, as was alluded to, a strong rebound thus far in April. we have seen, from a macro perspective, the fundamentals, GDP for the fourth quarter was 0.5%. Inflation in March was 3.3%. Now this is up from 2.4% in February. And no surprise, as we talked about, the increase in energy prices driving the market was the positive performer for the quarter, built on the back of rising oil and natural gas prices. Unemployment, 4.3% versus 4.4%. This is front and center with the Fed, as they've got the dual mandate of maintaining full employment or seeking full employment while maintaining a stability in prices. So the idea here is that the Fed did meet in March, and the outcome was to stand pat. What we saw from the participants in that committee meeting was a largely unanimity, as 11 of the 12 decided that their vote was to hold rates still. The idea here is that they are concerned about full employment, but also the specter of these rising energy prices. Is it short term? Is it long term? And then they came away with saying that at this point in time, they just don't know. There is too much going on the geopolitical front to make a determination whether this is an inflationary concern, depending on the duration of the Iran conflict and what takes place. So we've seen the markets react pretty wildly. Oil prices went from $61 a barrel in the first quarter to ending at 118 and now below 100. So again, you can just have some sense of the volatility that's taking place throughout this environment. So how does the portfolio perform during this period? If you turn to page 4, you'll see that this is showing the performance of the different asset classes in the shaded box to the right, showing that for the quarter, the return was negative 0.5%. Obviously, we don't ever want to see negative returns, but on the other hand, the blended benchmark was down over 1%. In fact, it was down 1.5%, a little over 1%, about 50 basis points or 0.5% of positive relative performance, which was good to see. The value as of March end was $37.2 billion. This was a decrease of approximately $405 million from the prior quarter end. Of that, we had investments lost about $194 million, and outflows were about $211 million. So for on a dollar basis, the assets decreased by about $405 million. Asset allocation was in line with the targets. And when you look at the bars below that, you can see the strength of the performance over the last year. Those are blue bars, but you also see those bars to the middle. Those are fiscal year to date. So you see solid returns coming from U.S. equity, global equity, international equity. And you can see that change in leadership that took place for the longest time. We were riding the coattails of a strong U.S. equity market and exceptionalism, but we've seen over the last year is international equity generating a 27% return, contrasted with U.S. equity at 15%. And then global equity, which is a blend of the two, was up about 22%. So again, diversification pays off. And certainly we see that, there is a lot of sensitivity, a lot of volatility in the market as while the U.S. has, quote, energy sufficiency from an oil standpoint, we see that the non-U.S. counterparts certainly have a greater challenge with respect to that. But it's a duration play. We know that the markets will go up, will go down, there will be events. But to understand the duration of these disruptions is difficult to gauge. The one thing that we can do is maintain a diversified portfolio. So, with that, any questions as I turn to the markets? Okay, the Fed, as we said, if we turn to page 10, it's a busy page, but I'm kind of a rows and columns type person, so it's easier for me to track that. But what we've seen is the Russell 3000, which is a very broad US benchmark, and the S&P 500, which is a large cap benchmark. We can see that both of those were negative. The Russell 2000 is small cap. So for an extended period, small caps have lagged large cap securities, but we can see over the last year, small caps as measured by the Russell 2000 are up about 25.7% versus 18 and 17% for the Russell 3 and S&P 500. As we look for the global, we see that they also were negative for the quarter. The MSCI World ex-US and emerging markets, our smaller market stocks were down 0.17, and small caps internationally were down. But we look over the 1 year period, again, we see some strong performance where developed markets were up 23%, emerging markets were up 29 and change, and small cap markets were up 27.8%. Fixed income, this is the Bloomberg aggregate, is the fixed income index, largely US investment grade denominated index, up 4.35% over the 1 year period, and we'll call it flattish for the quarter. Real estate has bounced back somewhat. Here we see that the NCREIF property index is up about 4.8%. Again, we see when you look at the 3 year number, you see that it's flattish to negative as we've all seen the challenges in the real estate market. And then again, the Cambridge private equity, this is on a lag basis, up about 9.5% for the 1 year period. Inflation at the bottom, coming in at 3.3%. So this has stepped up. It's a little higher than it was in February, which was 2.4%. And the driver here is when we strip out energy prices and food, we see that it's largely consistent at a 2.4% for the core, for the headline, I'm sorry. So let's turn to slide 12.
I would want to point out on 11, I love that periodic table because this further emphasizes what you were saying. It's good to have a diverse portfolio. Real estate, it's been a long time since we've seen real estate and small caps at the top and our large cap all the way at the bottom. So I like to look at this chart because it gives me an easy comparison. So yeah, but that speaks precisely to what you just said a few moments ago.
Sure, point taken. It's a very useful chart. Jay Kleffer came out with this chart in the middle 90s, and I guess his only regret is that he didn't copyright it because you see it. It's published quite often in a lot of different, whether it's wealth advisors or institutional advisors. But the quilt chart just illustrates at a glance why you don't put all your eggs in one basket.
Follow up what Dr. McCoy said 2 years ago. Yeah, I think y'all sat there and told us that real estate was just a drag on the whole system because during the COVID, people wasn't going to work in the skyscrapers and they were trying to find a way to sell them. The shopping centers were shutting down and went down to a smaller number. To completely turn around, that's kind of strange.
Well, I think like most things, there is temporary valuation squeezes and more permanent or secular. And certainly we think that, the landscape, no pun intended, for real estate has changed from the standpoint of what office is. But certainly residential housing and then specialized real estate, whether you're looking at student housing, things like that, have, again, COVID was such a unique environment and so pervasive that these valuations were really squeezed. And as we saw, as rates went up, it further challenged the sale of those properties. But we see that, it has bounced. Is it where it was? No. The idea here, in particularly in core real estate, is that the appreciation component is going to lag a little bit. but the income component is going to be taxed. So if your appreciation is flattish and you're getting your income, it presents a good stream of revenue, and it's diversified from your other asset classes. As they zig, this zags a little bit. Looking at page 12, this is, the point of this whole chart, there's a lot going in, but I would ask you to look to the far right, and you see that this is telling you how expensive is the US market, the S&P 500. And we can see that these dotted lines are telling you one standard deviation, which is like, let's call it the upper boundary and the lower boundary to tell you, is it really expensive? And as you can see, it peaked in December 31, and then it's come off for March 31st to come within that upper range. And again, as we look again, equities were priced for perfection, if you will, and any disruption that was going to take place was going to have a pretty drastic, so a great deal of volatility, and certainly we've seen that as we've seen it bounce below the dotted line, and if you were to look at it today, you're going to see it above the bottom dotted line. So the idea here is that U.S. equities are expensive, but the fundamentals are there. We have growth. They have delivered. That's not to say that their further disruption in the outcome or the duration of these headwinds that we see couldn't have an impact in terms of the overall growth. If inflation were to spark in, that would, again, further increase the prices of goods for folks. And if you have an employment issue, now you've got some significant problems. So the Fed's got a challenge to kind of balance the two. But suffice to say, we are not as energy dependent as our peers. So there are a lot of good things going for the U.S. market, despite the fact that it's highly valued. All right, U.S. equity performance, page 13. Again, interesting things taking place here as we see a change in leadership, if you will. I'm going to call your attention to the bars on the right-hand side and the Russell 1000 growth. So this is a large capitalization company growth index that has about, let's call it 45% information technology stocks. Information technology suffered a very difficult quarter, and we see that it was down 9.8%. Now, this is coming off the back of an extended period where it's outperformed, and we can see the value stocks, which has got a much lower portion of its assets are in information technology, and it's higher in things like financials. So we're not at all surprised, and given the price of oil and energy, you can see below the energy sector, the S&P 500 was up 38% for the quarter. And certainly that's come down. But as we look at the information technology, down 9.1%. So again, the idea here is that sectors will go in and out of favor. But again, the headwinds that information technology has faced is people are like, is it really worth all the money we're putting into this? Is everything going to result in the type of growth that we're looking for? That said, we also saw small caps over the last year outperforming their large cap brethren. As you see, the Russell 2000 was up 25.7% in the bottom bars, and the Russell 1000 or the S&P 500 were up around 17. Non-US stocks, we touched on this. That's page 14. Tough quarter. And some of the big generators in the emerging markets, China and India, down 9.9% and 18% respectively. But as we look over the longer period of time, particularly Charles highlighted emerging markets and Japan in particular, up 26%. Or emerging markets overall was up almost 30%. So again, we saw again, a more even balance between growth and value stocks outperforming in the non-US markets. Again, they don't have the same ownership of those magnificent 7 stocks that were so powerful in driving the performance. Fixed income. So in this volatile environment on page 15, we saw that the Treasury yields rose across most of the firm as the specter of inflation is apparent. And the The Bloomberg Ag was modestly negative, let's call it flat at 0.05%. The lower quality or the less safe portions of the fixed income market didn't perform as well as the treasury market. So again, in periods of anxiety, you're going to see people flock towards what they consider the safer security, and that being U.S. treasuries. And with that, I'm going to turn it over to Alex at page 18, which is the asset allocation page, but I'm happy to take any questions with respect to the markets.
Okay, great. Well, thank you and good morning, everyone. Good to see you all. Starting on page 18, we'll take a look at PERS itself, how it had performed given that market backdrop for the first quarter of this calendar year. Focus your attention to the percent difference column. You'll see most of those percentages are pretty tight, close to zero. Staff does a very effective job rebalancing the system. So those are where we want to see them. Importantly, they are all in compliance with the investment policy guidelines and rebalancing ranges. So everything looks good from an asset allocation perspective. On page 19, we'll look at how the system grew or shrank during the quarter. And based off what we heard about the market environment, so, you know, no surprise that it was a tough quarter. The system declined slightly, both due to investment return and cash flowing out. If we look at the investment return column, you'll see most of the red or the decline in value was concentrated in equities, particularly domestic equity. So there was a sell-off in stocks in the U.S., particularly in large cap and tech names. And because global equity has some of its portfolio invested in the U.S., it was also exposed to that sell-off. You'll notice below that international equity actually managed to squeeze out a very modestly positive return. So that was a nice buffer. Fixed income down slightly. Yields generally moved upward throughout the quarter. And as yields moved up, prices came down enough to kind of overcome the income generation, leading to these small negative returns. And then the rest of the asset classes below that, which are largely private markets, remained very insulated from this high frequency, you know, stock market movements, thankfully. And so that was a nice buffer as well, such that the investment return column in total was about negative 200 million for the quarter. Add about 200 million flowing out as well, and PERS declined in value as a result from about 37.6 billion to 37.2 billion at the end of March. So all told, kind of given the macro headwinds, the emergence of this new Iran conflict, it was a bit of a down quarter, but not as bad as I think it possibly could have been. And we'll see what the returns look like in just a moment. The other thing to remind you all, fortunately, after March, so through April, as you've heard, a huge snapback in markets. So these equity returns have come back into the black in a big way, really kind of recovering the losses that we saw in March. Now, when we take a look at the actual returns of the various asset classes on page 20, from the last quarter out to the last 5 years, you'll see exactly kind of what was happening based on the comments that have been made up to this point. So domestic equity, so the U.S. stock market, the source of kind of the biggest losses for the period. International equity actually outperformed when its benchmark was negative. It delivered a very small positive return owing to the aggregate of the active management. So they were able to protect your capital to the downside, which was a nice thing in this environment. And then, we get down to the total fund line at the bottom, you'll see down 0.53%, so a negative quarter. But when we compare that to the benchmark, was down almost twice as much. So the system did a very good job in aggregate protecting, again, the capital to the downside, delivering losses half of what the benchmark produced in that period. So 1 quarter, very short time window. As we start to look to the right over longer periods, I think what's very encouraging is that fiscal year-to-date column. You'll notice for the 9 months through March, the system was up 7.56%. So keeping pace with the actuarial discount rate, also in excess of the benchmark. To echo what Charles said, the estimate, if we fast forward into April through yesterday, that 7.56 jumps up to 13.9. So again, kind of reflecting the really strong recovery we've seen over the last couple of weeks. We hope that holds for the ensuing 2 months as we close out the fiscal year. And then beyond that, the last year, the system up 15.2, up 11.2 over the last 3 years. These are average annual compound rates. And then over the last 5 years, up almost 7. So again, doing a good job against the discount rate, doing a good job against the benchmark.
So the benchmark and our assumed rate of return were exactly the same for the last fiscal year?
For the fiscal year through March, yes, they were spot on. And then we'll close on 21, just, from a high level, let's zoom out a little further. And over the last 7, 10, 15 years, we can see kind of how the system has fared with this longer term view. And at the bottom, last 7 years up 9.3, last 10 up 9.4, last 15 up 8.6. So obviously on their own, those are strong numbers. When we compare them to the discount rate, they look good. And then when we compare them to the benchmark, they're also above that. So through those various lenses, particularly over this long time period, the system continues to perform very well, meeting its objectives. Now, there are individual manager instances that staff is addressing with Callan and maybe further action later in the year. Those are one-offs, but from a high level, the system looks quite good in this long-term view. Happy to take any questions the board members may have.
No questions? Go ahead. Paul?
The next item on the agenda is Global Public Equity Manager presentations. I don't know if this is a good time for.
I was going to ask the chairman what he prefers. Lunch is already, so you could break for lunch now and come back and do this after lunch, or if you want to do the previews first, however you prefer.
If you'd like, I can take you through the previews real quick, and then when we get back, we can start, with the managers, if that's.
Whatever the pleasure of the board is, you want to do the previews? We'll do the previews, and then we'll take our lunch break and come back and be ready for the presentation.
Okay, sounds great.
Okay.
And this preview, it was generated by one of my staff members, Ryan Holiday, but just in interest of time, I'll just take you through it real quick. Ryan did a great job on this report. The first manager that's coming in to visit us today is PGIM, Quantitative Global Solutions. This is one of our newest asset managers. They are a systematic multi-factor quantitative portfolio management team. As you know, that this team was hired to build a portfolio exactly for our needs. We are the sole portfolio in this product. This product has been doing exceptionally well since inception. It's basically outperformed the MSCI ACWI index by over 260 basis points for fiscal year to date, and since inception, it's outperformed by over 500 basis points. And the fee on this, we basically are keeping all of those returns. The fee on this is about 12 basis points. So the board was very, very shrewd in hiring.
Charles, how does this, when you say that it is prepared specifically for us, what, is it addressing that we had a need for there?
Well, we needed a growth manager in this space to fill a complementary role with the other asset managers that we have here. So we highlighted what we needed to fill this hole in our global portfolio, reached out to different quantitative managers to see what they could do to build something exactly to fit that, instead of trying to find something that already existed on the shelf and try to put a square peg in a round hole. So that's basically what I mean by they built something to fill our exact need. And it's so far done marvelously.
Okay, and let's talk a little bit about their cost structure. They're a little more expensive, this, or are they the same?
They're very inexpensive.
Okay, good.
They're, what we're paying for this active portfolio is approximately what you'd pay for indexing. The next asset manager coming in is Harding Loevner. They've gone through a bit of a rough patch. They've, over the time that they've been with us, they've been a very good asset manager. There's been a few changes in the portfolio management team, and this is one of the spots that we are currently reviewing, as kind of a little sore spot within the overall portfolio for global. The next asset manager that we'll be hearing from is Acadian Global. They too are also a quantitative asset manager. They've been managing money for us since 2005. Fantastic job for us. Their 5-year return, they've outperformed by 200 basis points a year for the last 5 years. No complaints with this portfolio. And then LSV is another one of our newer asset manager. They too are a quant portfolio. They are a value asset manager focusing on value and momentum within their quant strategy. They have done a fantastic job. In fact, over the time that they've been with us, they've outperformed when value should not have. So I think that there's, as you can see, for these global managers, out of the 4, 3 of the asset managers in this space are quant portfolios. And this is kind of highlighting the capabilities that quant portfolios with the advancement in technology is able to provide us. So with that, if there's any questions, I'll be happy to answer them. Otherwise, we can break for lunch and visit with them afterwards.
Is it okay with the board if we aim for 45 minutes for lunch, come back at 12:30?
Yes.
Is that good for you and the group?
That works for me, yes.
Okay, then we will recess for lunch and resume at 12:30. We're ready.
Managing Director and Head of Quantitative Equity, Kevin O'Rourke, and Carlos Prada are coming in to give us an update on their quant strategy for us. They should be headed in here in just a moment.
Turn my microphone zones up here so I can hear.
This first one goes through this book, we'll be here to dark.
Welcome, everyone. We're glad that you're here with us this afternoon. Welcome to our investment committee. And we do have your materials. If you will just let us know what page you're on, we'll be glad to follow along with that. So whoever is taking the lead, I'll turn it over to you.
Well, thank you very much. And my name is Carlos Prada. And I am the PGIM Relationship Manager for PERS. And I serve as the central point of contact for Charles and his team when they're dealing with the firm. Today I'm joined by Stacy Mintz and Kevin O'Rourke. Stacy is the head of quantitative equity, and she leads the portfolio management team. In addition, she is responsible for enhancements to our quantitative models and to our analytical tools. Kevin works with myself on the institutional client group. Kevin is responsible for business development and working with our institutional clients to understand their needs and offer solutions. So before I begin, I want to thank Charles and the team for the long-time partnership with PGIM. It's been over 14 years now with PGIM. I also want to thank the committee for giving us the opportunity for the update today. PGIM is, of course, the global asset management business of Prudential. And in 2012, this same committee approved and recommended hiring PGIM for our first mandate, a core plus fixed income mandate, and we appreciate that. Just last year, we were fortunate enough to win an additional global equity mandate, which is why we're here today. So if you look on slide 3, you'll see that we have deep expertise and experience across all asset classes. This includes equities, public and private credit, real estate, and alternative asset classes. We have a global platform, and we have offices around the world and have the privilege of managing assets for many of the world's largest pension plans, including PERS. So at this time, I'm going to turn it over to Kevin. He's going to say a few words more focused on PGIM Quantitative Solutions. And then Stacy will take over and provide an update on the mandate.
Thanks, Carlos, and good afternoon, and thank you for having us here today. I'll make a few comments focused on page 4. As Carlos mentioned, we are PGIM Quantitative Solutions. We are the systematic equity business of PGIM. We manage over $60 billion in quantitative equity portfolios, and our investment track records date back over 30 years to 1996. Our clients benefit from the fact that we can draw upon the resources of the entire PGIM, which, as Carlos mentioned, is a firm with over $1.5 trillion in assets under management. A year ago this month, we were hired by the board to manage a global all-cap equity mandate for PERS. This is a portfolio that's highly diversified. It typically has 350 to 400 holdings in it. It's all cap, meaning we're investing across small cap, mid cap, and large cap companies. And it is very much global in nature. We're investing across U.S. companies, international developed companies, as well as emerging markets companies. Stacy will walk you through our investment process as a refresher from last year, but in summary, we're looking for companies that are experiencing acceleration in their earnings and revenues, have high quality financial statements, but also are available at very attractive prices. I'll stop there and hand it over to Stacy. Thank you again.
Thank you. So performance for the strategy since we started managing it for you in mid-June, it's up 25%, which is about 5% better than your policy benchmark, which is a global benchmark. This has been an interesting market and a volatile one, so I'll walk you through what has worked in the portfolio and how our strategies perform in these types of markets. But first, I wanted to turn you to page 5, just to review our investment team briefly. There have been no changes to the investment team since we met with you last year. The portfolio management team reports to me, and being that we are a quantitative strategy, our investment expertise is all created in these models that we use. So all of our intelligence, all of our investment ideas go into a model, and then we can use that model to evaluate all 8,000 plus stocks in your benchmarks universe. We then, as Kevin said, look for companies that are good quality and have good growth prospects and choose about 350 to 400 for your portfolio. So my team's responsible for running those models, for seeing how our opinions on all these stocks have changed day to day, and then looking at your portfolio and making sure it's positioned correctly and to, give it a little refresh if our opinions have changed enough. They're also responsible for digging in and understanding why we're making certain trades. This isn't a black box type of quantitative management. We're looking for companies with good fundamentals. So when we see what we're buying and we see what we're selling, we'll understand the underlying components and why we're making those transactions. And then they'll work very closely with our trade desk to make sure that those transactions are executed in a very efficient and low-cost way. Gavin Smith runs the research team, and most of those individuals are on the right-hand side of the page. They're responsible for updating our models and finding ways to capture new information that can be put into those models and help improve performance. And as you can imagine, in this day and age, there is more and more information available in different formats all the time, and there are different techniques to be able to analyze the data. So that's what his team is responsible for. So together, we approve all changes to the models, and then those improvements go in and become part of our daily process. So we can move on to performance, which is on page 8. And so these are the numbers that I just referenced, the since inception at a little over 25% as a gross return for the fund, and with a track record of about 2.6%. So that's probably even a little bit less than we would think the typical tracking error would be for the portfolio. So a pretty solid year. It really does mask the volatility underneath, which we can talk about in a little bit. But when I looked at the portfolio this morning, since inception, we're up another 3%, and about 1.5% of that is alpha. So still strong even beyond these February numbers. So if you look year to date, so year to date here in the book, it says 263 basis points, and we've added again another about 150 basis points. So we've had similar excess return this year as we did last year. And that's important because these were two very different market environments. So last year, if you remember, people were very pro AI, and they loved US large cap tech stocks. And anybody who was investing in AI or talking about AI, the market just loved them. Even when there was volatility in the market, so when the tariffs were announced and the market's trying to figure out what, how this is going to impact individual companies, the market just fled to those big, large, good balance sheet companies that were involved in AI. The market's really changed a lot since then. So although we are still seeing an economy that's pretty strong, a little bit more worried about inflation now with the war going on in the Middle East, and worried about real economic impact of not being able to transport oil around the world. But now the market is looking at AI a little bit differently, which I think is the big significant change. And so it's looking at companies and saying, okay, what is the return on this investment for what you're investing in AI going to produce for me? So there's a little more scrutiny. There's a little more broadening out of rewarding growth companies that are not necessarily that large cap AI. And that's really what this portfolio was designed to do, is to find growth opportunities beyond just those big mega cap names. So it is designed to do well in most market conditions, and I would say that this is probably a good example where AI, mega cap AI was really hot last year. Now it's less so, but we're really looking for broader opportunities. If you turn to page 11, I think this tells you that story of where the excess return is coming from in numbers. So the top graph is breaking down this total dark bar, which is the total excess return over your benchmark for since inception. And you can see, a decent amount came from the United States, from Canada, emerging markets, IFA, all of those regions of the world, we've added some value. More so in the United States, mainly because it's the biggest part of the benchmark or the universe that we're investing in. It's about 60% of the benchmark is the US, so that is where we're going to get a lot of exposure. Below it is a table that breaks down the portfolio by sector. So the interesting thing here for this strategy is if you look at the relative weights, it's the fifth column over, it's relative active weights, you'll see that we don't take big positions in individual sectors. So as a growth portfolio, we're not just buying tech and not just buying healthcare. Instead, we're trying to find good opportunities in any of those sectors. So the good news there is that if you've got a market where big tech stocks are doing well, we're going to be in that space. But if there is a rotation like we've seen, where it's more so materials, defense stocks, different types of stocks are doing well as the market broadens out, we're going to have good growth positions in those areas as well. So what we're trying to do is within each of these sectors, within each of these countries, find good growth opportunities anywhere. So it's really a stock selection strategy and not a sector or a country tilt type of strategy. So that's important when you think about our outlook. Outlooks are tough. Who knows when the war is going to end? It seems like we always have some good idea that something's going to be settled about midweek, and then it kind of falls apart on the weekend. And it is significant because it is really affecting true, it is having a real economic impact on the world. For now, we see that the economy is still on solid footing. Inflation, although there's more worry about it, is still okay. But the longer this war drags on, the more that could be impacted. The good news for this strategy is we don't position the portfolio in order to take advantage of some future, economic or market situation. Instead, we're maintaining diversity. So regardless of what happens, this strategy should do better than your benchmark. So there are a couple of pages, page 12 and 13, there are some statistics about how the portfolio is positioned right now. And the key is on page 13 is that although we're managing to your policy benchmark, we are tilted towards the growth stocks. So in the upper right-hand corner, we're overweighting fast-growing stocks relative to the benchmark. So we are seeking those faster growth opportunities at the expense of more slowly growing stocks. So that is where we're forcing or making sure that we get that growth exposure. An outcome of that is we tend to have a little bit more in the EM space and emerging markets than we do developed markets because we're looking for more growth opportunities there. And then when it comes to sectors, as I mentioned, we're fairly, we don't take large sector positions, but you do see here that we are overweight healthcare and technology. As you would expect, there are better growth opportunities there, so we allow ourselves that flexibility. And then finally, on the bottom right, this is just a third-party view of the risk in the portfolio, and it's more towards momentum, which is another way to say the growthier parts of the market that we're tilted to rather than value. So, so we wish we could predict the future, because then, wouldn't that be wonderful? But this, to me, is a really good place to be, given the uncertainty in the markets around the world, still being able to take advantage of growth opportunities, but finding that growth in diversified places and not all your eggs in one basket. Any questions?
Questions from board members? Go ahead.
Innovation in your models. You're responsible for integrating new factors. Can you tell us what you're currently working on and what's been implemented or is on the chalkboard to be implemented?
Yes, so something was just implemented this morning that has been in the works for about 9 months. And it's understanding how companies are linked together, because we're trying to learn as much as we can about an individual company, but what's really important is how these companies all connect with each other. Because if something really good is happening in this company over here, it's going to trickle into other companies and vice versa. Many moons ago, what we paid attention to was industry. That's how you knew how companies were economically connected. But today, we know there are a lot of cross-industry connections. So one of the things that we've implemented is a customer-supplier relationship. So we see a company that's a customer, and if that company is doing really well, we're looking at all of the suppliers to benefit from that. So we're going to like those suppliers a little bit better because we know that this company is doing well. And that relationship actually goes down a couple of layers, which is what we just implemented as an enhancement, the suppliers of those suppliers, and understanding how that information isn't really priced into the market as quickly as that information on that original customer. And kind of another kind of similar factor there that we've included is analyst-defined networks. So if you're an analyst, you are responsible for a set of companies. And those companies are typically economically connected. So if you've got sell-side analysts that are all covering similar companies, then they must be connected in some way. So it's another way for us to look at a group of stocks and think that if there is a shock to that one of those stocks, it should have similar impact in those areas. So the bottom line there is we're looking beyond just evaluating a company in isolation, but also looking to how it's connected to other companies.
Thank you.
Others? On page 14, is that anything to do what you just described with the linkages factor exposure?
Absolutely. So we're increasing the linkages factor in our model. So it's a bigger part of our model. And linkages we see as another form of growth, whether positive or negative. So what this exhibit is showing is relative to your benchmark, how much are we overweight companies with good linkages factors and underweight those with poor linkages factors. So something bad has happened and the shock has trickled through. And then our other groups here, the growth factors, the quality factors, and the value factors are probably a little more self-explanatory, but that's exactly what that is.
Other questions from board members? Anything else that you all are just chomping at the bits to share with us?
No, sir, Mr. Chairman. We certainly appreciate it. Kevin, I don't know if you have anything fun
No,
to say.
it's great to be back and wonderful to see you all again.
Kevin, Stacy, Carlos, thank you so much for coming down. We appreciate the information. Keep up the good work.
Thank you.
And I hope you're enjoying our nice weather today.
Certainly am.
It's lovely. Thank you so much.
Thank you.
Make yourself comfortable. Good to see y'all today. I want to welcome you all to the Investment Committee of PERS. I'm glad that you all made it down and are here safely here in this beautiful, beautiful spring weather that we're having right now. So we do have your information. You'll just keep us abreast of where you are, what page. We'll follow along, and I will turn it over to whomever I need to turn it over to.
Great. I'm gonna be that person. It's nice to see you all again and be invited to speak to everyone to provide an update on the global portfolio that we manage for Mississippi PERS. I'm Lindsay Andreessen. I am the relationship manager from Harding Loevner. Rick Schmidt, I think many of you have seen over the years, and Ray Vars. We've always appreciated your partnership. I've been coming here for 14 years. Rick has been coming here for probably 7 years. Ray, we brought onto your client team several years ago. He's a member of our firm's 6-person executive committee, and he works with our key institutional clients. The 3 of us are partners of our firm, and on behalf of our firm, we want you to know that doing well and improving performance for our clients, for your pension members and retirees, is our top priority. And I'm going to turn it over to Ray to start us off.
Great. So start with the performance on slide 2. I mean, this year certainly we've experienced or witnessed an extraordinary sequence of events. Early in the year, much of the focus was on AI as it was last year, but it's pretty shocking that one blog post can send the market into a tailspin. So there's both excitement and fears. And markets, though, brushed that off and were up the first couple months, but that shifted with the conflict in the Middle East, and we saw a broad sell-off in March. And pretty much only energy stocks continue to march higher. The rest of the markets, pretty much across markets and across sectors, sold off in March and left us with negative performance for the quarter. Looking a bit longer term, we have here, looking since inception, going back 14 years, but more recent performance has not been up to our expectations. We failed to deliver the returns that we'd expect of ourselves and for you, particularly in the last 5 years. It's a combination of our own stock decision. Ultimately, we're making decisions about stocks, but we've also faced some headwinds in terms of style regimes. Going back 5 years ago, there was a sharp rotation to value in which we struggled to keep pace. And more recently, there's a narrow group of AI-related stocks, particularly in the U.S., a lot of momentum that's driven much of the performance. And we can really see that on the next, if I skip ahead to slide 4, you can really see the impact of momentum and concentration in markets. It's been challenging for us and many active managers investing globally. The chart to the left is looking at the top third of the market by momentum versus the bottom third, the relative performance. And what stands out is unprecedented outperformance of a narrow group of stocks and driven mostly in the U.S. and to a lesser extent, some banks and value stocks outside of the U.S. And that created a challenge. And you can see that also reflected in the concentration of the markets in the chart to the right, where we're looking at the weights of the top 10 stocks inside of the U.S. and outside of the U.S. So that extraordinary growth within the U.S., many of it call it the Mag 7, and their preponderance impact on performance is, again, to levels we haven't seen in many years, where 40% of the market is represented by just 10 stocks. This year, as I mentioned, we saw that swing from momentum and concentration to pretty much the opposite end of the spectrum, where just energy stocks performed well, and we struggled in that environment. But we're not changing what we do. On slide 5, we have an unwavering focus on investing only in high-quality growth businesses. It's what you hired us to do. It's what we're going to continue to do. That philosophy makes sense to us. We think it'll lead to long-term outperformance. But we think we can continue to improve. So we're continuing to focus on decisions we made, processes that we follow. Are there enhancements we can make to drive better decision-making going forward So we've implemented and developed a number of new tools related to risk, related to potential shortfalls in individual stocks. And we've implemented those and they're making a difference in the portfolio. Another thing is we've had a bigger focus on the valuation we're paying for some of those shares in the portfolio, and Rick will speak to that. You can see the positioning of the portfolio. We're finding a better trade-off today. And finally, amidst that volatility, amidst that swing in momentum in one place to another, we really are trying to take advantage of those market opportunities by keeping that long-term perspective, but taking advantage of dislocations to buy shares at better prices today. And maybe with that, I'll let Rick speak to what we're actually doing and how we're positioning your portfolio today.
Thanks, Ray. Well, if there's a silver lining in a market where a concentrated number of stocks, often low quality, are outperforming, and we invest in high quality, long duration growth stocks that aren't doing so well, is our opportunity set's getting cheaper. So in just 5 slides, I'm going to talk about what we've done in the portfolio, what we're seeing in markets, and how we're strategically set for going forward. So slide 6 is what happened in the portfolio in the last year. The maroon bar is the positioning on the left-hand side in terms of sector, on the right-hand side in terms of geography or region. The portfolio today as it was versus 1 year ago. I think it hasn't changed a lot. There's been some changes at the margin, but overall our sector overweights in terms of where we have our greatest investments versus the index are in healthcare and industrials, areas where we continue to find diversified, long duration growth companies at reasonable prices. On the right, while the U.S. is our biggest market, we're actually underweight the index. That's not a macro view on the United States or a view on we like Europe or think Europe's going to grow faster. It's a completely bottom-up driven view on where we can find the most attractive stocks in the world, and I'll come back to that later. So let's look at what's happened last year and what we think was going to happen going forward. So page 7, AI spending has been the major theme last year, and it will continue to be a theme into this year. We're being very deliberative in how we approach AI and in our investments. There's a lot of hype out there. There's a lot of companies that need to raise money. There's a lot of companies that maybe aren't so well positioned, and there's a lot of very expensive stocks. So we're applying the same process that we do for all of our investments. We do it for even something new like AI. And what we found there is these companies, which we've put into a graph or image of a data center. Over the top are the hyperscalers, the companies I'm sure you're familiar with and that we own. Amazon, Alphabet, Microsoft, Tencent is the Chinese equivalent. On the left-hand side are the companies that are providing the chips, the processors, the GPUs, the CPUs, the memory chips. Again, maybe companies that you're familiar with, all of which we own in the portfolio. Broadcom, NVIDIA, Samsung, and TSMC, which makes those chips. We're also finding interesting businesses that you may not be as familiar with. That's on the right-hand side in companies that are supplying these data centers with different products and materials. Power and cooling includes companies like Schneider Electric, which is actually based in France. Invent, a US company, as well as companies that are literally connecting the GPUs to the CPUs to the internet. Companies like Amphenol, the world's leader in these small connectors. Fabrinet, which makes optical components. All of these are dominant in their area, and we think are structurally well positioned to benefit no matter what happens in the AI cycle. Finally, we also watch valuations. So we've owned some other companies, and this hype that I warned about does sometimes happen in companies that we own. If we think that expectations are getting too high, we've been selling and finding better opportunities or opportunities in areas outside of AI. So besides AI, as Ray hinted earlier, the second factor that's clearly affecting businesses today and our investments is the conflict in the Middle East. I picked a slide, I think no matter what I would have chosen, by the time the ink dried, it would have been out of date. So I tried to choose a slide that showed what happened with the oil price, which we all know from filling our tank has been going up a lot, but also that the market in the longer term, and this is the futures, the orange line, going out, is showing, I think, a bit of complacency, or at least some certitude or comfort that long-term oil prices are going to come back down to maybe a slightly elevated level, $70 to $80 a barrel. That seems to me a bit complacent. We don't think we can predict exactly what's going to happen, but I do think there's a lot of risks out there in the world that aren't necessarily going to have us return to a nice, stable world of prices. In a nutshell, that's why we own a portfolio of businesses with quality, strong balance sheets that can handle volatility and still grow. And perhaps because of this complacency in markets, quality stocks haven't been rewarded. They've been underperforming in most places around the world. So we've used this as an opportunity to raise the quality of our portfolio at cheaper prices. And slide 9 shows what our portfolio looks like under some metrics. The chart on the left is our portfolio in maroon at a premium to the market in terms of quality and growth. And on the right is the price that we're paying for those stocks. The valuation of the portfolio is the lowest we've seen in this chart is 10 years, but it's the lowest since we started working together with you 14 years ago. The specifics of the portfolio, what we own in terms of the regions, sectors, as well as the top 10 holdings are on page 10. As noted, we're overweight the industrial and healthcare sectors, and on the right in the middle chart, underweight the U.S. In conclusion, I want to thank you for the opportunity that we've had to work with you and leave time for any questions.
Board members, any questions for our guests at this time? Charles, anything from the staff? Alex, go ahead.
Thanks. Yeah, back on page 9, so it shows the valuation of your holdings getting cheaper, so you're able to kind of load up on the strategy. But looking forward, when do you think the market kind of comes back to reward your holdings and you'll start to see that gap close?
I can't say Wednesday, but I can say that where we have historically performed the best is when markets are more in muddle through. It's what you'd expect from when growth is at hard to find, growth stocks trade at a premium. That hasn't been the case in the last couple of years. I can't tell you exactly, but my thinking is that we've already started to see momentum spread out. I feel a bit better about that. The quality aspect has not been rewarded. We'll have to probably have some tough times for that to occur. As well, as stocks get cheaper, you don't need to see so much of a turn in order for people to appreciate again. So I don't know when, but I'm feeling much more comfortable today.
Yeah, I think that it is tough to, we don't try to find catalysts, but in the long run, going back to the sort of Buffett saying, in the long term, the market's a weighing machine. Having that relatively low valuation relative to the high quality growth of the businesses, I think as the earnings come through on those sorts of companies, particularly in a difficult environment where I think there's a lot of stocks, whether they're bank stocks, where we saw a steepening of the yield curve or some policy change where earnings have grown quite a bit based on what's going on in the economy or outside factors. I think when those sort of dissipate a bit, that's where I think that separation happens for quality stocks versus the rest of the market, where they generate real organic growth. They're able to reinvest in their business. If we see energy prices stay high, these are the businesses with pricing power that can pass that through. So I think ultimately it comes through with the earnings growth of those companies are going to start to look different than the rest of the market. And that's, at some point, if the market's efficient, should be reflected in the valuation, higher valuations.
I have a question. On page 6, that relative to energy, limited amount of change in there, and I think you scored that as of March 31, 26. Is that before any activity in the Middle East that would have any effect on that energy change?
So we did not change the portfolio, and this is 1 year, but the prices would have gone up. So that on average, they went up about 30-something% in the first quarter. So some of that increase is the reflection of that price. I think all of it, actually, because we didn't make any transaction.
Okay.
Are there any positions in the portfolio that you would have anticipated would have done better in this market that haven't, and you continue to hold them, and why?
So everything I bought, I thought would have done better than the market. I say that flippantly. No, that we own some companies. Like, look, to me, what you really want to do when you're thinking about markets and volatility is you want to be prepared for anything. So we own those energy stocks. Did I know that there was going to be a war in the Middle East and oil prices were going to double, triple? No. But I knew that energy prices were relatively low and they're companies that were attractive and underpriced. Some of the companies that have not done well, we own some software companies. I still own 3 software companies. The market is not happy with those companies. They think AI is going to wipe out these businesses. They're really being priced for terminal values for the businesses to be impacted. I've had the market said the same thing about Google a year ago. Google was down like 30% in the beginning of 2025 because ChatGPT, you're just going to use that as your search function, not Google. Over the year, Google not only proved that there was still a good market for their products, but they also developed Gemini and had very good, basically, they used AI to their advantage. And Google was up 60% for the year. I think that's the lesson. So why am I still holding my poorly performing software companies? Is I do think the approach that we take to understand the industry, understand the competitive advantage, it's still there. People aren't going to be able to replace them, but what we're going to need to see is them starting to adapt, and instead of being disruptive, to be adaptive of AI. But that's my bet. I can't guarantee it. It seems to me that the prices are not pricing in any good news in those stocks. I think there will be some of the best long-term gains in the portfolio from those stocks now because of the fact that everyone hates them.
I'd say healthcare might be the other place that over the last couple of years, again, there's concern from above and potential policy change has weighed on the overall sector. And coming out of COVID, growth slowed for a number of those areas. It feels like we're past that and we're seeing results come through. There's still some policy uncertainty out there, but it feels like an area where innovation is driving growth. It's not reflected in the prices from the bottom up. And so that continues to be an overweight in the portfolio, but has weighed on relative performance over the last couple of years.
Thank you.
Other questions? I do not believe that we have any more questions. However, is there anything that's just on your heart that you want to share with us this afternoon? If not, we thank you for coming and visit with us and giving us this report. Thank you for the good work and continue to do so in the future. Thank you so much. Here.
Thank you for your time.
Good afternoon. Glad you're here this afternoon. And welcome to the Investment Committee of PERS of Mississippi. We do have your materials in front of us, so if you'll just let us know where you are, we'll try our best to follow along. And so I'm going to turn it over to whoever wants to take the lead.
I'll start.
James, would that be you?
That's me.
Okay, go right ahead.
Thanks so much, and thanks for having us here today. We appreciate it. It's good to be with you folks. I'm here with my colleague Anna Papouche. Anna's a portfolio manager at Acadian. My role is as a relationship manager, so I work with Charles and his team to service you folks. But we appreciate you making the time for us this afternoon. We'll endeavor to be brief. I think we have about 20 minutes and then about 5 for questions. Is that right? Okay. Where we probably start, I can give you a quick update on Acadian and the firm. Slide 4 in your materials. It's typically where we start. Just get it on my computer screen here. Yeah, so this is just a quick snapshot of Acadian, where we sit today. I'll make a few comments. I know it's been a couple of years. Feels like yesterday I was sitting in this seat, but it's been a couple of years already since we were here. I can make a couple of comments just as a refresher to you on kind of who Acadian is and what our investment process and philosophy is. And then I'll hand it over to Anna, who will cover performance and give a little bit of an update on our philosophy as well and positioning. So you folks may recall Acadian's a systematic investment manager. We've been in business since 1986. We have our 40-year anniversary this coming summer. So what does systematic mean? Some people say quantitative or systematic. It's really just using a lot of data and technology to help us select investments, select companies. The process itself is really grounded in fundamentals. So we do think of ourselves as fundamental stock pickers, but we're just using a lot of data and technology to help us to broaden the playing field and to look at many more companies than a more fundamental manager would be able to look at. So we think that's kind of our edge is really expanding that investment opportunity set and looking at many more companies. Importantly, being systematic allows us to be objective and to remove human emotion from the process. So we know as investors that we're all prone to making behavioral errors, and that's just a known flaw in investing. So what we try to do is remove all human emotion from the process. Any sort of judgment is built in at the front end, and we try to allow ourselves to get ourselves out of the way and be as emotionless and objective as possible when selecting, doing stock selection. The chart here is the donut chart, is just a quick overview on where we are as a firm. So managing just under 180 billion. That's across a number of different strategies. The global equity strategy that you folks are in is in the sort of the bottom of the donut chart there, just over 50 billion. That encompasses a number of different global strategies. You folks are in our global all-country equity strategy, what we call our core equity strategy. That product has just over $8 billion in it today. If you turn to slide 5, I can maybe just make a couple of comments here. This is just I believe this is in some of the other materials that we sent you as well, but this is just a overview of the investment team. The different functional areas that fall under our chief investment officer, who is Brendan Bradley. Brendan's sort of the final decision maker on all things that happen within the investment process. But there are a number of teams that report up to Brendan, and this kind of follows the way we think about our investment process. So the first team on the far left is our investment analytics and data team. So as a systematic and a quantitative manager, the data that we ingest is hugely important, making sure that it's of the highest quality,
It's our lifeblood. So there's a whole team of folks that are 100% dedicated to investment data. And some of the analytical tools that we use are developed by this team as well. Next team, the next box over, the Global Equity Research Team. These are the folks that are looking at our stock selection forecasting model and trying to improve that. So how can we get better at what we do? It's an evolving, very competitive marketplace, obviously, and so we want to stay ahead of competition. So these folks are, very talented team of people that are looking for maybe it's new signals or new data sources, different ways of combining the information that we use to inform our judgments. So really important function. The next team over is our equity portfolio management team, and Anna is a member of that team. So you can see a large team of very talented folks. Our portfolio managers have a number of different roles. One of which is coming out and speaking with clients, such as we're doing here today, explaining performance and how the portfolios are positioned. But importantly, the portfolio management team serves as a quality check as well. Before we go out to trade any portfolios, a member of Anna or her team will be signing off on every portfolio, every trade before it's released to the market. And then they work also hand in hand. There's a lot of these boxes make it look like there's silos. There's really a lot of overlap here, a lot of gray area. Anna will work with the equity research team on different projects as well. And then finally, implementation. That's $180 billion investment management firm. When we go to trade, we know that we can have an impact on markets, and so we want to minimize that footprint that we have in the marketplace. And so this team is focused on making sure we're using the best transaction cost estimates and not pushing prices too much when we're in the marketplace. So another really important function. Unless there are any questions, I'll turn it over to Anna, and we'll kind of give you maybe a quick update on the philosophy and a very couple of comments on our investment process. Then we'll jump right into your portfolio and talk about the performance.
Great. Thank you. Thank you for having us today. It's nice to meet you all. Going over to slide 7, just to briefly touch on the philosophy. Jim sort of already previewed this, but ultimately at our core, what we're doing here is picking stocks. And we're doing it in all of the ways he described in a very data-driven, systematic way. From a philosophical standpoint, we definitely don't think that markets are easy to beat, but our goal is to beat them and to build you and our other clients portfolios that are diversified, that give you consistent returns over time, and that are well spread across countries, across sectors and industries, and that are risk controlled, and ultimately, giving you the return expectations that you're looking for. And as Jim said, we do that in a systematic way. So everything we do is data driven. But when he talks about, the input being on the front end, what he means by that is we're looking at different intuitive, financial accounting things. How do the valuations of these companies look? What does their cash flow look like, et cetera? Basically, if you were to acquire a small business, what would you look at? You would look at the balance sheet. You would look at various different metrics, P&L, et cetera. We're doing that, right? But we're just doing it at scale, and we're doing it for public equities. So that's kind of the way to think about our process as a whole. If you take a quick look at slide 8, I'll just do a really brief summary again of our investment process. What you'll find here looking at the slide is it's a very nice mirror to the structure of the investment team that Jim just took us through. So as you think about what we're trying to do here in the entire global all-country universe, we are forecasting the performance for over 40,000 stocks. We're doing this all day, every day, throughout the day, as markets are opening and closing globally. And as you saw on the firm summary page, we have a lot of global offices. So we have a presence in London, in Singapore, in Sydney, and then our main office in Boston. So we do have coverage from a trading perspective and a portfolio management perspective in all of those places. And we like to say if a stock is on an exchange, we are generating a forecast for it. And how are we generating these forecasts? We think about our alpha across a couple of dimensions, and that's where that general equity research group comes in. They're using all of this data, and they're ultimately coming up with some metrics around value, quality, and growth and technicals, so fundamental themes that you're used to seeing, but our proprietary take on them. They're also looking at macro level signals, right? So comparing countries to one another, comparing industries to one another. When we think about countries, thinking about things like how is the currency doing of that country? When we think about industries, how is the momentum? How does energy look relative to materials? Things like that. And then we also have a peer model where for every individual stock, we build a custom group of stocks similar to it economically. So are they competitors or suppliers of one another? Are they owned by similar groups of mutual funds? Things like that. We roll all of these different lenses together into one cohesive forecast. And again, doing that for over 40,000 stocks all day, every day. And then as with the rest of our process, when we think about construction and trading, both of those are also systematic processes, but as Jim said, with multiple levels of human oversight. So the idea there is to, again, build your portfolio where you're getting as much exposure to our alpha as possible, but being cognizant of cost and then being very cognizant of risk. So not taking too much exposure in countries or in industries or in currencies, and then similarly not taking too much exposure, say, in individual stocks or, on size, on market cap, volatility, things like that. And portfolio managers like myself are involved here at this portfolio construction step, both to be a feedback loop to research and then to make sure that things are behaving as expected. So as Jim said about signing off on trades, typically 2-3 times a week, someone like myself will sit and look at the trades. How's the portfolio tilting? How's the positioning changes? When we go through, global macro events like what's happening in the Middle East, how is that affecting the portfolios? Are they moving in a direction we're comfortable with and is in line with our philosophy? And the same goes for trading, again, systematic, data-driven, and multiple sets of eyes. And so ultimately from end to end, what we're doing here, like I said, building diversified portfolios, giving you consistent return streams, doing it in a very thoughtful and data-driven way, and continuously investing in the data, in the people, and in the process. I'll just pause for a moment. Are there any questions I can help answer on the process, on the setup, philosophy, anything like that? I know we have about 10 minutes to review.
I'd like to know approximately how many portfolios your team deals with.
300 to 400? Is that a good ballpark?
Yeah.
Total 300 to 400 or so.
How do you keep our portfolio uppermost in your mind?
So each portfolio, we build out a trading schedule where a certain subset of portfolios are on that schedule every given day. So a portfolio like yours recurs on the schedule about twice monthly, every 10 business days or so. And then on a given day when it's on reviews, it will be looked at individually. So on a day when I'm on reviews, for example, I'll be on reviews the next 3 days this week. I will open each portfolio one at a time, and I will look just at the trades for that portfolio. So they get a very firm sort of independent set of eyeballs on them very regularly.
And a quick question on this page too. When you talk about conducting all these forecasts for all these individual stocks, what is the time horizon that you're
Thinking about
most working with there?
Yeah, great question. So I won't get into the details given the time constraint, but you can see on slide 9, if you have the book already open to both pages, that, for example, of 2.5% stock forecast. So the window we think of that over is loosely the next 3 to 6 months. So the interpretation there is for any given stock, we're saying this stylized example, we think this stock will outperform the others in the global universe by about 2.5% for the next 3 to 6 months. And in building that forecast, we look at everything from the next month to the next 2 years when we're rolling up that number. Are there any other questions I can? Yes, understood. I'm watching the clock behind you. I want to be respectful of your time.
I just want you to cover all that you wanted to cover.
Understood. I appreciate that. So if I could ask you to turn to page 24, I'll give you a quick overview of the last trailing 12 months performance and maybe also briefly speak about month to date. And just touch on positioning and take any other questions you might have. So what you're looking at on slide 24 is sort of what we call our internal report card, so to speak. So it's our portfolio return attribution. The purpose of this exhibit is essentially to understand that bottom line. So that's the active return of what we are adding for you on top of the index. And we're showing this, by quarter and then trailing over the past 12 months. So the interpretation there, if you look at that 3.7% in the bottom right corner, is we have added 3.7%, again, trailing 12 months over the index. And of that 3.7%, 4.6 is due to our alpha. And then we've given a little bit back, you can see in the risk line, which is the second in that blue area in the bottom half of the table. And you can see a summary. I spoke briefly about these different flavors of alpha. The main takeaway over the past 12-month period that stands out as we look at, the magnitude of them and the positives and negatives is value has worked well, technicals, things like momentum have worked well. Quality has struggled, especially over the past 2 quarters. What that's really due to is we've been in this very speculative market environment that's AI everything. And so what we've found is investors are kind of uncomfortable with more expensive valuations for higher quality companies, and they're kind of piling into market-driven, mega cap, large names, things, AI everything. And so we've seen that, reflected in a more challenging performance of quality. As a factor, it's had its most challenging year out of the past 2 decades. The last time quality struggled this much from a fundamental quant standpoint was in 1994. So that's kind of a high-level summary from sort of what's driving the alpha pieces. In general, if we also look at year-to-date, so this exhibit is only showing you as of Q1 to give you a preview how things look as of April, through today. The portfolio is actually substantially up thus far this month. It's up another 1.8%, really riding the coattails of really strong performance out of things like semiconductors in Asia, so places like Korea, places like Taiwan, and then also rallies in places like US tech and media, right? So thinking about Alphabet up, companies like Seagate that are making data centers doing really well, and also consumer services. There's been, resilient spending and a good job market. And so we've seen people spending money on things like Airbnb, Expedia, Booking.com, et cetera. So in general, performance has been strong.
Oh, just gonna,
jump in.
Yeah, just to clarify, the 1.8 is a relative number. So the actual portfolio is up over 11% in April alone. So as you guys have probably been aware, markets are swinging around pretty wildly. There's a little bit going on in the world, but it's nice to see, in an absolute sense, the portfolio is up over 11%, and we've been able to add value, over and above the index. So nice to see.
Yeah. I think year to date, the index is up about 6%. So again, adding, another 5 or so % on top of that. Since the Middle East conflict, probably worth underscoring a little bit, the portfolio has been very stable. We take risk controlling very seriously in our process, again, because so much of it is data driven, of course. In terms of impact from physical places affected, places like Israel or places like Saudi Arabia, UAE, et cetera, there's been basically very flat impact in all those areas since the conflict started in March. In general, our positioning both there and in energy has held up quite well since the conflict broke out. And then speaking of positioning, if you go back 1 slide to 23, you can see a nice visual of what that looks like. Most recently as of Q1, both across countries and across industries. To give you just a couple of talking points there, if we focus on the right side there on industries, you can see we hold more than the index in places like semiconductors, which of course have done well with AI and memory chips, et cetera. Pharmaceuticals have done really well on the back of a lot of demand for GLP-1s. So companies like Johnson & Johnson, Eli Lilly have had really great earnings and growth. In the financial services space, we actually hold less than the benchmark, and that's been great. Companies like Visa and MasterCard, with some of the government regulations coming out, capping credit card fees, holding less than the benchmark has actually been beneficial because they've underperformed. And similarly, if we look on the left side, you can see by country what's done well. In the Asia space, Taiwan and South Korea, again, semiconductors have done really, really well in that area. Poland might surprise you, it kind of stands out. There's one particular stock we hold there in oil and gas refining that has had a really great run this year, given everything going on in the Middle East. And then China, probably a talking point, that's worth just underscoring, has had some good performance across the board. Some of the really big names in China, the Tencents, the Alibabas, we actually find somewhat unfavorable and overvalued. So we underweight them, hold less than the index. That's been helpful. And then other places like PetroChina or large banks have done well locally there as well. I'll take a pause. I know we have just about 5 minutes. Is there any questions I can help answer related to performance or positioning? Yeah.
Go ahead, Joe.
So Anna, can you talk to us a little bit about the attribution and the contribution for factors like, what is peer? What does that cover?
Yeah, that's a great question. So the peer model, the idea behind it is for each individual stock, we build a custom peer group of 50 stocks similar to it. A good example for that would be something like Amazon. Amazon typically would fall under the bucket of a US retailer, but if you or I hear Amazon in the news, we don't think how is Macy's doing? We think, how are the other Mag 7 stocks doing, you know, your Metas, et cetera. So the idea of the peer model is to look at economic linkages. Are analysts talking about this stock in similar groups? Is it a supplier or competitor of another stock? How are they maybe co-moving? And so what the peer model covers is those grouped relationships.
And in the, on page 24, where you show the contributing amounts, are they, when you think of the factor approach and attribution, are there expectations of a particular factor that's going to be more influential in the excess return than others, and what would those be? Like we see the quality's been a detractor, right? Pretty significantly.
Yep.
But if you look in your modeling, is your expectation that it would be a big factor or a lesser factor than the other ones listed?
Yeah, so the column just next to, so I think you're looking at the very last column in that table, right?
Yep.
The column just to the left of it is showing you the split across how much weight we have on average over the last year in each of those dimensions. So to your point, you know, we have about 18% sitting in quality and value, you know, another 8 in growth, et cetera, et cetera. So that's how much influence they have, so to speak. But those numbers are not static, they change. And so as markets change and what works in predicting returns changes, those weights will change too. Certainly, I don't think any of us expect something like a long, prolonged quality underperformance for half a year. Typically, those things revert and perform much stronger on the backside. But in terms of how impactful it is, you can see that there's, you know, 36% of the alpha alone sitting in value and quality. So typically, we do expect those over the long term to do well. And likely, you know, hopefully, we will bottom out in terms of the quality piece soon.
I would just say too, it's over a 12-month period, you know, we can get periods where these factors, you know, may have a, you know, face headwinds, but over any longer period of time, we would expect positive returns, or else it wouldn't be in our model, right? We believe that quality's a, you know, we want to hold higher quality companies, and that over the long term is a winning strategy. So we'd expect that over the long term to be a positive contributor.
Thank you.
Other questions? I don't think our board has any more questions. Anything else that you'd like to share as we get close to the end?
No, I don't think so. I just wanted to thank you folks. I think we hit our 20-year anniversary with you folks last year in 2025. The portfolio was incepted in 2005. So we thank you for the support and the long partnership. It's certainly much appreciated, and we'd love to see the long-term client partnership. So thank you.
We thank you all for coming down. Thank you for your hard work. We want you to continue to do that for us, and we appreciate you all.
Thank you.
Absolutely.
Likewise.
Yes.
Thanks so much.
Welcome to the Investment Committee of PERS. We do have the information that you have provided to us.
Okay.
And we will follow along. You'll just let us know where you are. And so I'm going to turn it over to you.
Great. Thank you. My name is Scott Kemper. Appreciate the now almost 4-year relationship we have with you. Certainly a rocky ride with a lot going on in the market. So I'll talk a little bit about that today and talk about how that's impacted the portfolio we are managing for you. Yes, it is a global portfolio benchmarked to the MSCI All Country World Index. So we are investing in the U.S., non-developed U.S. markets and the emerging markets. So I'll review all that. Very briefly on the organization, I'll spend no more than 60 seconds just to let you know everything is very stable there. Firm-wide assets under management are $105 billion. We've been in business over 30 years now. One of the things we're very proud of is of our 350 institutional clients. 100 have been with us for more than 20 years, and I think that speaks to, one, the organizational stability we've had, but also the predictability of the returns. I think our portfolios that we manage tend to be broadly diversified. We do what we say we're going to do, so there aren't a lot of surprises. So that's resulted in long relationships with our clients. So we're very proud of that. Have our representative client list on pages 5 and 6, which show those tenures. Page 7 on the organizational structure, we've had no changes to the team. We did announce a new partner as of January 1st. Ron Graziano, who's our Director of Accounting Research, became our newest employee partner. We are a majority employee-owned firm, so that's a key way that we retain people, and we now have 24 of our 47 employees are owners of the firm, so we continue to expand that. Other than that, no changes to the team or the organization. I might have gone just over 60 seconds there. Happy to answer any questions on the organization if you have it. Okay, let's get to the fun stuff then, the portfolio. I'll start on page 11. As I mentioned, this portfolio we were hired to manage for you all is a global value equity portfolio benchmarked to the MSCI All Country World Index. Our goal is to beat that index by at least 2.5% per year, annualized over a full investment cycle. We have achieved that so far to start. The environment has been favorable for our value approach. I'll talk a bit about that. And then importantly here are the risk controls that we have in this portfolio for you. So we take a lot of small positions. We have about 250 stocks. It's a quantitative model we use to rank stocks around the world using our proprietary research. We do have top-down risk controls where we are effectively country neutral relative to the benchmark weight. So we won't be overweight any particular country or underweight. We think it's difficult to predict those geopolitical considerations. If you think a number of years ago, back when Russia invaded Ukraine, many value managers were very overweight Russia. The market overall was very inexpensive. No one could have forecasted a war was coming, and then all of those stocks were delisted and the market went to zero. So that approach has served us well. We don't think we're able to take a guess on when countries are going to outperform other countries. So we take that risk off the table. Sector risk is controlled at plus or minus 5%. So we let our model take us to where it finds attractive opportunities. But we won't let the overweight get to more than 5% overweight or underweight 5% as well. And then finally, individual stock constraints. We'll limit the overweight we can have to any individual name. However, if the model does not like a particular stock, even if it has a very large weight in the index, we will not force the portfolio to buy it. So I think this quantitative approach that we have has served us well in that it allows us to take emotion out of the decision-making process and be very consistent in how we run this portfolio for you. When the world is going to hell in a handbasket, it's difficult to sit around a table and make, I think, good judgment calls on what to do. The energy sector right now, should you be overweight, underweight? We are guided by the model, and we think over time that allows us to be very systematic and clinical and disciplined in how we make decisions. Not to say, though, that it's this computer model that executes these trades blindly. There's a lot of human interaction, I should point, in the back end of the process before we buy or sell any stocks in your portfolio. So page 12 shows the characteristics of the portfolio. Essentially, the belief that we have, our founders have here, is that value stocks outperform over the long run because there are behavioral biases that investors have. Just to list a couple of those, one is they tend to project what's happened in the past too far into the future. So if you think of NVIDIA and the AI excitement and a lot of these stocks that became very big weights in the US index, they just kept going up and up and up. I'm sure you're familiar with all those. We think investors tend to take that past growth and project it too far into the future, meaning they're willing to pay too much for that future expectation of growth. So those are examples of companies we don't get excited about. We think investors get too excited about them. So we've been very underweight those names, which didn't help for a period of time. But as things have reversed and those stocks have started to struggle, that's benefited us. So the types of companies we own in your portfolio are more stocks, companies that investors tend to have low expectations about in terms of their ability to grow in the future. These are not stocks that are going to grow as much as Microsoft or Apple, but if the expectations are that they're supposed to grow 2% and they can grow 5%, that's a pretty nice return, nice multiple expansion. So we like companies that have been out of favor. There might be low expectations for their ability to grow in the future. They're quality companies, meaning they have cash on the balance sheet. They're generating consistent earnings, so they're not distressed companies. And that they trade at very low multiples relative to the index. And you can see that on page 12. We've built a portfolio for you with over 250 stocks that's trading at a forward price to earnings of 10.4 versus 17.9 for the benchmark, and even a much bigger discount than the value benchmark, which trades at 14.9 times. And again, I really want to emphasize too that we aren't getting that discount by compromising on quality. So these are companies that have cash on the balance sheet. Bankruptcy risk is very low. We stay away from those companies that are very cheap on book, that don't have cash on the balance sheet. So these discounts we see for the portfolio are among the biggest we've seen in our 30-plus year history. So generally that bodes well for future excess returns. And then finally on this page, one more thing to mention is that the portfolios you see, if you look at the size measures and the weighted average market cap, is quite a bit smaller than the index right now. And really that's a function of two things. One, we are, as a value manager, we like those companies that have underperformed the market on average, so they tend to be smaller companies. We're avoiding the NVIDIAs, the really large mega cap companies in the index. But the 823 billion weighted average market cap you see of the index shows how large some of these companies have become. The S&P, as you know, got over $1 trillion weighted average market cap, which is unprecedented. So we view the top half of that market, these very large companies, particularly in the US, as too big, too expensive. We've been underweight those names, and that's certainly been a boost to performance when we look at your portfolio, and I'll talk more about that in a moment. Any questions on just what comments I've made so far before I move on to performance? John?
So, Scott, you talked about being country neutral, and you raised the issue of Ukraine, right? At what point is there an intervention to say, okay, the model we might be saying it's attractive from a value perspective, but you're reading the headlines, you're seeing the tanks roll up to the borders. Is there an intervention in the portfolio at that point?
You know, there may be a discussion on the team when we're looking at individual names, when we're doing a rebalance, which we do every 6 to 8 weeks. Portfolio turnover, I should say, is low, 20% on average. So we're not trading a lot in this portfolio. So when we do visit names that the model might be suggesting to sell, there's a discussion about it. But I think we avoid the inclination to override that on a country perspective. You know, maybe it's already priced in, right? That this war could be coming, or it's hard to know what the impact has been so far, what it's going to be. We don't have conviction in our process that we can get that right and time it. So we're just trying to pick the best stocks within each of those countries, the most attractively priced.
Thank you.
So I'll jump to performance just in the interest of time here to keep things moving. You can see it's not a long track record yet. You hired us back in August of 2022. The portfolio is up 18.4% annualized. The core benchmark's up 13.9, and the value index is up 12.4. Generally, it's a more favorable environment for us when the value index is outperforming the core and the growth indices, but it hasn't been a wide spread, so we're still have been able to add good value above both benchmarks in a period where value and growth have been, somewhat flat over that 4-year period. We had a little bit of a tough period relative to core in 2023. You can see that we underperformed the core index by 4.5%. That was when NVIDIA, the large tech companies in the US, were still performing very well. They have big weights in the core index, not much of a weight in the value index, so we did very well relative to the value index, but lagged the core index. And that continued in 2024 when we underperformed by 5%. So we did have a bit of a tough period relative to core, and it was really driven by the non-exposure or the significant underweight to the large tech companies in the US. That all flipped over in 2025. I remember talking with Ryan and Charles that, we were really excited about how the portfolio was positioned and how expensive a lot of these companies were. And should that turn, you should expect us to benefit disproportionately, which we did in 2025. That's continued into 2026. When the Middle East war broke out around March 1st, I think that really even more so hurt the U.S. tech companies. So we really saw the tech companies, the large companies underperform. Microsoft is one stock that we don't own, was down 23% during the first quarter. So that contributed 75 basis points of relative performance, just that one name. And then on the value side, obviously energy did very well in March. Once the war started, oil prices were up, and kind of the expectation that there'd be less supply of fuel. So energy did well, which has a bigger weight in the value index. Some of the consumer names really held up better, not surprisingly. Staples and consumer discretionary, that benefited value, benefited our portfolio. And then the emerging markets, we started to see separating out between the commodity exporters. So think Brazil, obviously hurt a market like that, or helped a market like that, but importers like India were really hurt, where they depend on so much oil coming in the country and have to pay a premium to get that. So I think what we saw in March, and I don't have month performance here, is the portfolio held up well. So during the month of March, it was down 6%. The core index was down 7.2%, and the value index was down 7%. In April, the markets rebounded quite strongly. The portfolio is up nearly 9% in April. The core benchmark's up 9.6, so we're a little bit behind core, but value's up only 6.8. So since March 1st, portfolio is is outperforming the core index by a little bit and about 3% ahead of the value index. So nice to see it held up well when the market went down and the war started. And now that things have rebounded, the portfolio continued to do well. So year to date through yesterday, the portfolio is now up 13.7%. We have 4.6 here as of the end of March, so it's nice to see that. And the core index is up 6.1%, so we're a little more than 7% ahead of core so far to start the year. So a lot of nuggets I've thrown out there, but long story short, things have really come our way in terms of our approach and what we do. Just nothing that we've done differently. The market's just kind of come our way. I think the good news is that we continue to see widespread in valuations between these large, expensive companies and value companies. You saw that in how the portfolio valuations trade at such big discounts relative to the market indices. So we have optimism that the portfolio continue to perform well relative to the benchmarks. I've got a lot of other information in the, maybe if I could jump back, I really just wanted to share this slide with you on page 26. Because I know early on in our relationship, we talked a lot about the influence of these large stocks in the US. So I thought anytime you can put on a chart, a 100-year chart, to me, that's pretty powerful stuff. So this is the relative 10-year return spread between the top 10 stocks in the US versus the next 490. So think the S&P 500 over time. So how are those top 10 stocks performing versus all the other 490 stocks over the preceding 10 years? So what's the 10-year return? And you can see currently, this was as of, this is as of January 31st, so a couple months old now. That line's come down quite a bit, but what that 8.77% is suggesting is that the top 10 stocks in the US outperformed the other 490 by 8.7% per year over the last 10 years. And obviously, if you look back over history, it's unprecedented in terms of how big of an impact or how much those top 10 stocks outperformed. In the technology bubble in the late 1990s, it got to about 3% only. And then back in the mid 1950s, it got a little bit above 4%. And here we were at 9%. And again, that's come down a little bit now with these tech names underperforming. But I think this just shows how out of whack the market really got and how high of expectations there were for these mega cap tech companies, not just even in the US. If you look outside the US and some of the Korean, Taiwan names, China a few years ago had Tencent and Alibaba, and they've since come back down to earth. So just thought I would share that chart. It's a kind of a powerful 100-year chart. Happy to go into more detail on the portfolio or how it's positioned or anything else that may be of interest.
Other questions? I think we may have exhausted those.
Okay.
So, one last thing you'd like to share with us?
No, thank you for the business. We appreciate the relationship. And, I think we're excited about how the portfolio is positioned. And obviously, it's a lot going on in the world. But I think, our approach in times like these gets some validation that it's difficult to kind of make these calls. So we will stick to what you've hired us to do. I can promise you that. And, whether things are working for us or against us, we believe strongly in it. So we'll continue to do that.
The returns have been a blessing to us, and we want to encourage you to continue that in the future.
We'll do our best.
Okay. Thank you so much
Thank you
for
all.
coming.
All right. Have a good afternoon.
Way to come, just to show. I think that.
I'm sorry.
Go ahead.
Are they all going to quantitative management? Is that just the trend of the future? I think you've got 3 of the 4, and the 4th one is the one who's not doing well. That's not quantitative.
Well, I don't think it's necessarily the case that if you're not quant, that you're not going to do well. It's just that the trend in quant management has been that the technology has now become of age where you actually can program your own in-house AI models to do exactly what you need them to do, and it does it very efficiently. So I think that's what you're starting to see show up in the returns. So it's not that traditional asset management's dead. It's just
Going to use AI along with it.
we found a way to better uncover value, and this one in particular has uncovered value in a way that value asset management in the time that they were outperforming should not have done that well. So there's something there in their models that's able to pick out winners in the marketplace. So I don't think that's going to change. I think it's I think it's only going to get better as time goes as this technology matures. So the world's changing. It's exciting. So that's where we're at.
Any other questions for Charles concerning, quantitative or qualitative?
They're quantitative.
Quantitative, you know, I just thought it was, statistics, but I just, but it's a unique way of using statistics, I guess. So,
The last items I have for miscellaneous updates, it's just some changes with, you know, a couple of our asset managers. Fisher, there's a, you know, a promotion, and then with TA Realty, you know, one of the, you know, leadership team, you know, members has decided to, you know, pursue an opportunity outside the firm. I mean, neither of these two give us any concern, nor have a absolute direct impact on what they're doing for us. So this is just informational, just to let you know what's going on with the firms. That's all I have.
okay, it was a great report at 13.88 or 13.9 or 14, whichever rounding error that we want to use. So appreciate the hard work of you and your staff. I'm assuming it'll be 10 a.m. in the morning.
Yes, sir. 10 a.m. tomorrow. Claims committee up first.
Anything else for the investment committee? We stand adjourned. See y'all in the morning at 10.